stop scrolling. Because what you're about to hear is not what politicians want you to focus on, and it's definitely not what most people are prepared to admit. Every time prices rise, they point fingers. Corporations, central banks, global crisis. But almost no one dares to say this out loud. Some of the biggest inflation pressures are being created by the very policies meant to protect you. And once you see it, you can't unsee it. Think about this for a second. Inflation isn't some mysterious force. It doesn't appear overnight. It builds quietly, decision by decision, rule by rule, speech by speech. While headlines distract you with noise, the real drivers are working in the background, squeezing supply, tightening labor, raising costs one layer at a time, until suddenly your rent is higher, your groceries cost more, and your paycheck feels smaller even though you're working just as hard. Here's the uncomfortable truth: markets already know what's coming before you feel it. Investors price tomorrow's mistakes today. And right now, the signals they're reading are not reassuring. When policies restrict trade, limit talent, and interfere with institutions designed to control inflation, the outcome is predictable. Prices don't fall, they dig in. This isn't about politics. It's about math. It's about incentives. It's about whether leaders are willing to confront reality or keep selling comfort while inflation eats away at everyday life. The most dangerous kind of inflation isn't the kind that shocks you. It's the kind that becomes normal. So stay with me, because once you understand why inflation is being fueled, who is actually paying the price, and what markets are silently warning us about, you'll realize this conversation is far bigger than a single policy, a single party, or a single headline. When we talk about inflation, we often search for villains that sound dramatic or solutions that sound patriotic. But markets don't respond to slogans. They respond to costs, incentives, and constraints. And one of the most persistent mistakes policymakers make is believing they can raise barriers without raising prices. You cannot tax the flow of goods, labor, and capital and expect inflation to politely step aside. Tariffs are a clear example. They are often sold as a way to protect domestic industry, but in reality, they function as a direct cost increase embedded into the supply chain. When you raise the price of imported components, raw materials, or finished goods, businesses don't absorb that forever. Margins compress, investment slows, and eventually those costs are passed on to consumers. The result isn't economic strength. It's higher prices at the register and less flexibility for households already under pressure. The same logic applies to restrictive immigration policies. Labor is a core input in almost every sector of the economy. When you reduce the legal supply of workers, whether they are building homes, staffing hospitals, driving trucks, or writing software, you tighten the labor market artificially. That tightness drives wage inflation in key sectors, which then ripples through prices for housing, healthcare, logistics, and services. This isn't a moral argument or a political one. It's basic supply and demand. What's especially dangerous is the combination of these policies. When you restrict trade and restrict labor at the same time, you squeeze the economy from both ends. Supply becomes less elastic, bottlenecks last longer, shocks take more time to resolve. Inflation stops being a temporary problem and starts becoming structural. That's when central banks are forced into more aggressive actions, and those actions carry their own costs: slower growth, tighter credit, and higher risk of recession. Markets see this clearly. Investors price inflation not just based on today's data, but on tomorrow's policy trajectory. When they see governments leaning toward protectionism and inward-looking labor rules, they don't assume prices will magically fall. They assume higher long-term costs, higher uncertainty, and a higher premium for risk. That feeds directly into borrowing costs for businesses and governments alike. None of this means that borders don't matter or that trade should be unmanaged. It means policy must be precise, disciplined, and grounded in reality. Smart economic leadership focuses on expanding supply, not constraining it. It understands that competitiveness comes from productivity, innovation, and scale, not from artificially limiting options. Inflation is not beaten by rhetoric. It's beaten by policies that allow goods to move efficiently, talent to flow where it's needed, and businesses to respond quickly to demand. When policymakers forget that, inflation reminds them slowly, painfully, and at the expense of everyday citizens. There is a tendency in politics to treat regulation as a moral victory rather than an economic tool. The problem with that mindset is simple: regulation has costs, and when those costs are poorly designed or excessively layered, they show up in prices. Inflation is not only a monetary phenomenon, it is very often the byproduct of friction. And regulation, when misused, is friction institutionalized. Deregulation does not mean chaos. It does not mean abandoning safety, fairness, or accountability. It means asking a disciplined question, say, does this rule increase productive capacity or does it slow it down? When regulation delays housing construction, restricts energy development, or complicates logistics, it constrains supply. And when supply cannot respond to demand, prices rise. That is not ideology. That is arithmetic. Look at housing, excessive zoning restrictions, environmental review processes that take years instead of months, and overlapping approval authorities have made it extraordinarily difficult to build at scale. The result is not better cities. It is structural housing inflation. Rents rise, home prices surge, and younger generations are priced out. No central bank can print more apartments. Only supply-side reform can solve that problem. Energy tells the same story. When permits are delayed, pipelines stalled, or investment discouraged by regulatory uncertainty, energy prices become more volatile and more expensive. Energy is not just another sector. It is an input into almost everything. Higher energy costs cascade through transportation, manufacturing, and food production. That ripple effect is inflationary by design, even if unintended. Smart deregulation lowers these pressures. It shortens timelines, reduces uncertainty, and attracts capital. Capital flows toward environments where rules are clear, consistent, and efficient. When businesses can plan with confidence, they invest. When they invest, capacity expands. And when capacity expands, competition increases, which is the most reliable force we have for lowering prices over time. There is also a productivity dimension that is often ignored. Excessive compliance burdens divert resources away from innovation and toward paperwork. Smaller firms suffer the most because they lack the scale to absorb regulatory overhead. That reduces competition and entrenches incumbents, another subtle but powerful driver of higher prices. Deregulation, when done responsibly, levels the playing field and restores competitive pressure. Markets reward this clarity immediately. When investors see credible efforts to remove unnecessary barriers, they adjust expectations. Inflation premiums ease, long-term rates stabilize, and growth outlooks improve. This is not theoretical. It is observable in capital flows and asset pricing. Policy signals matter, and deregulation sends one of the clearest signals of all: supply will be allowed to respond. Inflation does not fall because leaders promise it will. It falls when economies are allowed to function efficiently. Thoughtful deregulation is not a political slogan. It is an economic necessity. When supply is unleashed responsibly, prices follow reality, not rhetoric. Inflation control ultimately rests on trust. Trust that monetary policy is guided by data discipline and long-term stability rather than short-term political pressure. Once that trust begins to erode, inflation becomes far more difficult to manage, not because the tools disappear, but because their credibility weakens. Markets do not wait for official announcements. They anticipate behavior. And when they sense interference, they react immediately. Central bank independence is not an abstract constitutional principle. It is a practical requirement for price stability. Monetary policy works through expectations as much as through interest rates. If businesses, investors, and households believe inflation will be controlled, their behavior reinforces that outcome. If they believe policy decisions are being influenced by election cycles or political agendas, inflation expectations drift upward. And once that happens, reversing it becomes far more costly. Political pressure on monetary authorities often comes disguised as concern for growth or employment. But history shows that prioritizing short-term growth at the expense of price stability leads to worse outcomes on both fronts. Artificially low rates in the face of inflation distort capital allocation, encourage excessive risk-taking, and delay necessary economic adjustments. The eventual correction is harsher, longer, and more damaging to the very workers such policies claim to protect. Markets price this risk quickly. When independence is questioned, bond yields rise to compensate for inflation uncertainty. Currency values weaken. Capital becomes more cautious. These reactions are not ideological judgments, they are risk assessments. Higher borrowing costs then feed back into the real economy, raising the cost of mortgages, business investment, and government debt service. The irony is that political interference meant to ease economic pain often amplifies it. A disciplined central bank is willing to make unpopular decisions when conditions require it. That willingness is the anchor of credibility. Without it, inflation expectations become unmoored. Wage negotiations begin to assume higher future prices. Businesses raise prices preemptively. Consumers accelerate purchases out of fear of rising costs. Inflation becomes self-reinforcing, not because of a single policy error, but because confidence and restraint has been lost. There is also an institutional dimension that matters deeply. Strong economies are built on predictable rules and respected boundaries. When lines blur between fiscal ambition and monetary authority, uncertainty rises. Investors and businesses struggle to plan. Long-term capital hesitates. Productivity growth suffers. These are slow-moving effects, but they compound over time and leave economies weaker, not stronger. Protecting independence does not mean isolation or arrogance. Monetary authorities must communicate clearly, transparently, and honestly. They must explain trade-offs and acknowledge uncertainty. But communication is not subservience. The line between listening and yielding must remain firm. Once crossed, credibility is not easily restored. Inflation is not defeated by pressure campaigns or public demands. It is defeated by consistency, restraint, and institutional integrity. When monetary policy is allowed to operate free from political influence, markets respond with confidence. And confidence, more than any single rate decision, is the foundation of lasting price stability. Economic truth does not change depending on the venue in which it is spoken. Whether the message is delivered behind closed doors to investors or publicly at a global forum, the fundamentals remain the same. Inflation is shaped by policy direction, and policy direction is judged by consistency. When leaders speak on major stages, markets are not listening for applause lines. They are listening for signals. Public economic remarks matter because they reveal priorities. When policymakers emphasize protectionism, barriers, and short-term political wins, markets infer a future of constrained supply and higher costs. When they emphasize openness, productivity, and institutional discipline, markets infer stability. These signals are absorbed instantly and reflected in asset prices, capital flows, and risk premiums. Words, when spoken from positions of influence, are not cheap. Global investors compare countries relentlessly. They ask simple questions. Where is capital welcome? Where is talent allowed to move freely? Where are rules predictable and institutions respected? When answers begin to weaken, capital reallocates. That relocation has consequences. Reduced investment means less capacity. Less capacity means tighter supply. Tighter supply means inflation pressure that no speech can talk away. What's often underestimated is how interconnected the global economy remains. Trade, capital, labor, and technology move across borders with speed. Attempts to wall off an economy do not insulate it from inflation. They amplify it. Costs rise domestically while efficiency falls globally. The illusion of control replaces the reality of competitiveness, and the price level reflects that disconnect. High-profile economic commentary also influences expectations beyond markets. Business leaders make hiring and investment decisions based on policy signals. Households make spending decisions based on confidence in future stability. When rhetoric introduces uncertainty or hints at policy volatility, behavior changes. Delayed investment, accelerated consumption, defensive pricing. These are rational responses to unclear direction, and they all feed inflationary dynamics. There is also a credibility test embedded in public remarks. Do stated goals align with feasible actions? Promising lower prices while endorsing policies that restrict supply creates a gap markets cannot ignore. That gap erodes trust. Once trust weakens, even sound policies face skepticism. Inflation expectations rise not because of one mistake, but because consistency has been compromised. Strong economic leadership understands this responsibility. It recognizes that transparency and realism are more valuable than optimism detached from evidence. It avoids oversimplification and respects the intelligence of markets and citizens alike. Most importantly, it aligns language with action. Credibility is built when what is said publicly matches what is implemented privately. Inflation is a global problem shaped by national choices. When those choices are explained clearly and defended honestly, markets adjust constructively. When they are obscured by politics or contradicted by reality, markets protect themselves, and the cost of that protection is paid by consumers. In the end, forums and interviews are not about persuasion, they are about trust. And in economics, trust is not emotional. It is measurable. It shows up in yields, in investment, in prices. Say the wrong thing often enough, or say the right thing without following through, and inflation becomes not just an outcome, but a verdict. Immigration policy is often debated in emotional terms, but its economic impact is precise, measurable, and deeply connected to inflation. Labor is one of the most critical inputs in the economy, and when access to that labor is restricted, costs rise. This is not a philosophical position. It is a structural reality that shows up in price data across multiple sectors. When legal immigration pathways narrow, businesses face an immediate constraint. They struggle to hire workers at every skill level, from highly trained professionals to essential frontline roles. Scarcity in labor markets drives wages higher, not because productivity has surged, but because supply has been artificially limited. Those higher labor costs then flow directly into prices for housing, healthcare, food, transportation, and services. Consumers absorb the impact quietly, bill by bill. The housing market illustrates this clearly. Construction depends on skilled and semi-skilled labor. When that labor is in short supply, projects are delayed, costs escalate, and fewer homes are built. Limited housing supply pushes rents and prices higher, intensifying inflation where it hurts most. No amount of demand management can compensate for the absence of workers needed to build at scale. Healthcare faces a similar challenge. Hospitals, clinics, and care facilities rely heavily on immigrant labor. Restrictive policies strain staffing levels, increase overtime costs, and reduce service capacity. The result is higher healthcare costs and longer wait times, an inflationary outcome paired with reduced quality. Again, this is not ideological, it is operational. High-skill immigration matters just as much. Innovation, productivity growth, and long-term competitiveness depend on attracting global talent. When visa systems are unpredictable or overly restrictive, investment decisions shift elsewhere, startups launch in different countries. Research expands abroad. Over time, productivity growth slows, and slower productivity is one of the most persistent drivers of inflation. An economy that cannot grow efficiently becomes an expensive one. There is also a timing element policymakers often miss. Labor shortages do not resolve quickly. Training takes years. Demographic trends are slow moving. When immigration is restricted today, the inflationary effects can persist for a decade. That long tail makes inflation harder to control and increases the burden on monetary policy, forcing higher rates for longer than would otherwise be necessary. None of this suggests abandoning border security or rule of law. It suggests aligning immigration policy with economic reality. Legal, orderly, demand-driven immigration expands supply, reduces bottlenecks, and stabilizes prices. It strengthens growth while easing inflationary pressure. A rare policy lever that does both. Inflation is not just about money, it is about capacity. Workers are capacity. Talent is capacity. When policy constrains that capacity, prices respond predictably. A serious approach to inflation recognizes this and acts accordingly. The question is not whether immigration affects inflation, it already does. The question is whether policy will acknowledge that fact or continue paying the price for ignoring it. And this is where everything comes together. Because inflation doesn't end with a headline, it ends with a choice. Every policy leaves a footprint. Every speech sends a signal. And markets are listening long before voters feel the impact. When supply is restricted, when talent is pushed away, when institutions are pressured instead of protected, inflation doesn't disappear. It waits. It settles in quietly, turning temporary into permanent, turning patience into frustration. The most dangerous moment is not when prices are rising fast. It's when people start accepting them as normal. That's when inflation wins. That's when households adjust downward. Ambition shrinks and opportunity becomes more expensive than it should ever be. And once that mindset takes hold, reversing it costs years, not months. But here's the part few talk about. This outcome is not inevitable. It's not written into the economy. It's the result of decisions, and decisions can change. Supply can be expanded. Talent can be welcomed. Discipline can be restored. Confidence can be rebuilt. And when confidence returns, inflation doesn't just slow, it breaks. Markets don't ask for perfection. They ask for clarity. They ask for consistency. They ask for leaders who understand that real economic strength is built quietly, not shouted loudly. When that understanding is present, capital flows, prices stabilize, and growth becomes sustainable again. So the question isn't whether inflation will shape the future. It already is. The real question is who will have the courage to confront what's fueling it and when they'll choose reality over rhetoric. Because the longer that decision is delayed, the higher the cost becomes. And when the dust finally settles, history won't remember the slogans. It will remember the results.